Hey guys, it's Henry. In this very special video, I'm going to show you how to trade poor man's leaps like a professional. I'm going to show you how to close and how to profitably actually manage this position. And all three of these positions are still going to be small portfolio positions because the poor man's leap is amazing for small portfolios. Let me show you an example. I'm going to look at Tesla. Today, it's selling off to the low 200, so it's currently at $203 per share. Say that you're bullish on Tesla. I'm not giving my viewpoint on the stock in this video. I'm just simply showing you an example of how to utilize this poor man's leap to make a lot of money if you're bullish. If you're not bullish on Tesla, then find a different stock that you can do this on. Tesla is just my example because this stock has a lot of volatility, which makes it a pretty good candidate for a leap poor man's covered call. You can do this poor man's covered call using leap options on way cheaper stocks, whether it's Palantir or other cheap stocks, and this would only cost you maybe even $50 if you want it to be. So now I'm going to buy a leap call option. For this to qualify as a leap, I have to go out an expiration that's about 1 year ahead for it to technically be considered a leap option. I'm looking at January 19, 2024, which is about 13 to 14 months out from the recording of this video. Again, if you're watching this in the future, you can still run this strategy anytime on any stock, so long as your leap option is 1 year out or roughly about a year out. It could be 9 months, that would be a really shorter term leap option, or it can be up to 2 years. That would be a perfectly fine leap option as well. So now I'm going to click January 19, 2024. Now, for this to be a proper leap option by textbook definition, and by the way, sometimes I do bend the rules, but for it to be a technical leap option, you want it to be about a 80 delta, roughly 80 delta. Sometimes I bend the rules and I go for 70 delta, or even lower than that. But first of all, let's start with 80 delta and I'll show you more examples with the pros and cons along with it. Okay, so let's expand this 160 call option. As you can see, it's a 77 delta. This is close enough to 80. This is good enough for me, okay? Right around 80 is fine. Now, keep in mind, the higher the delta, the more that this option is going to be similar to stock, okay? However, if I go down, as you can see at 150, it's going to be a higher delta, but it continues to get more expensive. The sweet spot for me, therefore, is around a 75 or 80 delta, because although it is expensive, really expensive, you can still get this for a better price than the stock itself. So for example, the stock is $202, but right now the premium here is only $80. So you can still control the same 100 shares, but for $80 versus $202, okay? Now this is still going to be a fairly expensive trade. However, when I factor in the covered call premium, I'm going to show you that this is actually not that expensive. Let's go to buy call option, expiration is January 19. So we're gonna go ahead and buy this 160 right here. This is considered a deep in the money call option. The reason why it's deep is because the stock is 202 and the strike here is 160. So it's deep in the money. And as you can see based on the chart right here, the stock is right here. It's right in the money. I mean, it's in the money by about $42, okay? So $42 in the money. This stock can fall $40 down and it would still be an in the money option. That's why it's called deep in the money. Now, the volatility is 66 or 67. That's pretty high. Typically, I'm looking for above 50, okay, when I'm selling options. Now, this is actually buying an option. However, it's fine because the poor man's leap also involves selling an option. So implied volatility is actually not that important for this position. What is important is that you actually pick a stock that you like, that you think is going to go up, and using the poor man's leap, you now have advantage because you don't have to put up as much capital up front to control 100 shares of this stock that you hopefully like. Now, to make this a poor man's leap, what I'm going to do is I'm going to sell a covered call option on this. Currently, this is $8,000. Really expensive, which is why I mentioned you can do this strategy on different stocks. You don't have to use Tesla. This is just an example. What I'm going to do though is now go to sell call option, and I'm actually going to use the same date. Now, you don't have to use the same date. For example, let me actually start off with doing a monthly covered call. So today is October 24th as I'm recording this video. I'm going to go out to November 25th, which is roughly 30 days out. Okay, currently the stock is $202 per share. What I can do is I can sell a 10% out of the money call option. Okay, 10% is important because you want it to be out of the money. You don't want to get in trouble by selling a call option that would be too close, because then you're going to have to close the position for a potential loss. If you're bullish on this, you want to give yourself a proper strike price that is far enough out of the money where you can benefit, but also not really be at a risk to have to close the position or roll the position. By the way, rolling is a separate topic. I will also have that in the description for you. Now, what I'm going to do is go about 10% out of the money. Now, if you're going for a volatile stock, for example, I'm using Tesla, then maybe you want to go even farther. You can go out about 15% of the money. So 15% would be about $30 higher. So now I can sell this call option right here and collect $535 by selling this call option, which expires in 1 month. And because this call option right here that I am buying, this LEAP call option, which is basically our foundation, this is our 100 shares, if you will say. It's not exactly 100 shares, but it acts very similar to 100 shares. This 160 call option right here, okay? This is basically our foundation, our 100 shares, which acts very similar to owning stock, except we only have to put up $8,000 instead of $20,000, okay? So more than half off up front. Now we can start collecting $500 on 8,000, or really 7,500, since we're collecting $500 and we're keeping it from the very moment that we sell. From the very moment that we sell this $230 call option, we're getting almost a 7% return in 1 month. So if we were to do this for 12 months straight, then we would make about an 84% return, roughly. And since this call option actually expires in roughly 14 months, we can actually get exactly back what we put into this option. We can make roughly $8,000 in 14 months. So we can get all of our capital back, and actually this 160 call option will just function as a free call option, okay? So we can actually make this somewhat free because of all the premium that we collect on a monthly basis. So 14 times, if I collect $500, I'm going to make roughly 7 grand, and this option cost me roughly 8 grand. But this 8 grand option will actually still be worth something. For example, if this option actually does nothing and it just stays at around $200 per share for Tesla by expiration in 1 year, which if you think to yourself, if you're buying and using this strategy, you're probably bullish. But let's just say that the stock has no returns whatsoever. Well, at expiration, if you were to successfully sell these call options 14 times, you would have $7,000, and this call option at 160 would actually still have a value of about $4,000. So in this example, you can make all the money back that you put up front and still make about $4,000 on this position, which would be a 50% return. Now, let's say that the stock that you're holding goes up, right? You would expect it to go up. If the stock were to go up, then you would make significantly more money. For example, how much money would you make? Well, it would really depend. So for example, if the stock just went up by 10% and it stopped at 220, then you would be in the money by this 220 strike minus this 160. So basically 6 grand, and you make your money back by selling the covered calls on a monthly basis. So now you're up 6 grand on 8 grand. That's a 67% return. If the stock went up by 20%, right, it would be at $240. You would be up a full 8 grand on this call option, and these covered calls that you sell would pay off exactly how much you're spending up front, which is the 8 grand, okay? So you would pay off the 8 grand and be up 8 grand, basically meaning that you turn 8 grand into 16 grand in 1 year. So you would double your money. Is this realistic? Well, basically it's as realistic as it gets to growing a small portfolio aggressively. Because what's likely to happen is this covered call will more than likely be successful. However, you're going to have to manage it properly, because some months, maybe the stock will go up to, let's say, $215 per share. Now, you're not going to want to sell the $230. You're going to want to go up a little bit higher. Or let's say that the stock falls down to $190 per share. In that case, you won't be able to get that much premium by selling the $230. Instead, you're going to probably have to sell the $220. So there's a very fair balance of how to actually manage the poor man's leap. That's actually one of the downsides, is there's a lot of management involved. However, if you don't want to have any of the management, then let me show you how you can actually simplify this, open up one poor man's leap, in one trade and leave it alone and just profit without doing too much work on a monthly basis. So let me get rid of this 230 call. Instead of selling a 230 call on a monthly basis, you can just sell a call option on the same expiration date as the poor man's leap. So now I'm going to go back to January 19, 2024, and instead of having to open up so many positions on a monthly basis, I can just sell a call option once and leave this position alone. So let's say that I think that this stock will go up to $204 per share in 1 year from now. Again, you might think it could do more, you can do less. You can do this strategy on any stock that you wish to do this on, okay? This is just an example. So on the 240 strike, what I'm going to do, let's say I think the stock will go up by 20%, okay? If the stock goes up to 20%, it's gonna be about $240 per share. So I can actually calculate how high I think this stock will go and then sell a poor man's covered call exactly at the strike at which I think there's going to be some resistance. So now I'm going to sell the 240 call, boom, sell that right there. Now you will notice that I have a pretty good risk and return profile. I am long the 160 call option, which is a deep in the money leap option, and then I'm selling a poor man's covered call, but I'm selling this poor man's covered call which also expires on the same date. So in theory, this is a special poor man's covered call, which is actually a call debit spread. Regardless, the definition isn't really important. What I'm trying to point out here though is that the risk and return is very favorable. Your maximum loss is $3,500 and your maximum profit is going to be $4,467 if the stock goes up to about $240 per share. At 240, you realize your full profit. But somewhere in between, let's say the stock just goes up by a little bit, you're still making a really good return on a smaller amount of capital. Now, of course, you can lose what you put up. You can lose up to $3,500. However, if you think about it, way less money than buying 100 shares, right? If you buy 100 shares and the stock goes up to 240, you make $4,000. But now you can do the same thing and make $4,000, a little bit more actually than $4,000, and you only have to put up $3,500 instead of $20,000. So in my opinion, using the poor man's leap is way smarter than buying stock. The advantage is you can grow a smaller portfolio with way less upfront capital. And actually, with this example right here, you don't really have to do anything. You don't have to close this position. You can wait 1 year, and if the stock goes up, you can then close this position close to expiration date. So say January of 2024, or maybe even late December of 2023, this position may realize about 80% profits. So 80% profits would be about, $3,500. So you can double your money in about a year, or you can wait a little bit longer and realize this full amount. So let's say that the stock goes up to $250 per share. That's fine. You can actually just close this position on the very last day, January 19, 2024, and reap more than a 2x return on your money right here, which again is very, very unlikely in a stock market scenario because the stock market typically goes up by 10 to 12%. This position right here allows you to double your portfolio value. Now, word of caution. I wouldn't put your entire portfolio into this position. You should absolutely diversify by spreading your money across many positions that are within the realm of the poor man's leap. For example, if I had $10,000 or let's say $20,000, I would do a few positions. I would have 5 to 10 positions in the poor man's leap, and that's how I would spread my money across multiple different stocks that I like. Make sure that you replay this video if needed, master this trading strategy, and I promise you're going to see a lot more results in your trading. And make sure that you check out my playlist for more videos on how to master and improve your option trading and make more money.